Hey there, welcome to the YouTube channel Forexer. In the world of trading, some savvy individuals employ a unique one-to-one risk-to-reward ratio system, and it's not a bad idea at all. This approach can expedite the development of your self-assurance. Given that trading is a psychological game, having confidence is absolutely paramount. On the flip side, there are those traders who opt to bide their time for those elusive, picture-perfect opportunities to step into positions offering substantial risk-to-reward ratios. In this video, we'll delve into the art of targeting, both single and multiple, using a variety of strategies. Moreover, I'll be unveiling a cunning tracking technique that equips you to seize those mind-boggling risk-to-reward ratio trades. If this piques your interest, please don't forget to give that like button a gentle tap to show your support. And if you're new around here, consider subscribing to our channel. We regularly share advanced trading insights and strategies that can take your skills to the next level. In trading, your profitability is determined by two key factors: your win rate and your risk-to-reward ratio. The win rate represents the percentage of your trades that result in a profit. For example, if you win 5 out of your 10 trades, your win rate is 50. Many traders tend to focus on finding a trading system with an exceptionally high win rate, believing it's essential for profitability. However, this perspective can be misleading. The risk-to-reward ratio also plays a crucial role in determining your profitability. So what exactly is the risk-to-reward ratio? It's a tool used in trading to assess the potential return on the amount of risk taken. For instance, if your stop loss is set at 10 pips and your target is 30 pips, you have a 1-to-3 risk-to-reward ratio on the trade. In simple terms, if you are willing to risk 3 of your capital on this trade, you stand to gain 9 if it turns out to be a winning trade. In conclusion, while a high win rate is important, it's not the sole factor in achieving profitability. A favorable risk-to-reward ratio is equally crucial in determining your overall success in trading. In the realm of trading, it's important to note that trading plans with a lower risk-to-reward ratio tend to have higher win rates. These plans are often more mentally suitable for novice traders who may seek consistency and lower stress. On the flip side, trading plans with a higher risk-to-reward ratio enable traders to let their profits run and potentially gain the maximum benefits from market swings. Now, let's move forward and delve into some of the most effective profit-taking strategies that traders have developed over time. These techniques primarily aim to enhance profitability and prevent a winning trade from turning into a losing one. We will discuss two distinct strategies: taking multiple targets and the tracking technique. Let's begin with the first one, taking multiple targets. This technique involves setting 2 targets. In the first step, we aim to reach a break-even point and then allow our profits to run until we hit our second target. Imagine you've spotted a bullish engulfing candlestick pattern and decided to open a long position on a currency pair, anticipating a price rise. Your initial stop loss is set below this candle, giving it a 20-pip buffer. Now, let's consider what happens if we set our first target at a 1-1 risk-to-reward ratio and close half of our position when the price reaches that level. This approach leaves us with a winning trade involving half of our position and a 20-pip target. Even if the price subsequently reverses and hits our stop loss, we won't incur any losses. This method effectively safeguards our profits and prevents a winning trade from turning into a losing one. There are 2 ways to execute this technique on your trading platform. You can either choose to close half of your position when the price reaches your first target, or you can opt for the method of opening 2 separate positions. These 2 positions will each have half of your initial position size on this trade. For instance, if you're willing to risk 2% of your capital on this trade, you'll need to open 2 positions, each with a 1% risk. Set the first target at a 1-to-1 risk-to-reward ratio for the first position and reserve your higher time frame target for the second one. This approach ensures that your total risk remains at 2% and you'll have 2 distinct positions open. As for taking multiple targets, you have the option to choose a fixed amount like 1-2 or 1-3 risk-to-reward ratios for the second target. However, our preference is to identify key levels on higher time frames and set our second target at these significant areas. For example, if we zoom out to the 4-hour chart, we can clearly observe that this specific area has previously served as a robust resistance zone. Just take a look at all those rejections in the past. Therefore, if the price were to return to this significant key level once more, we can reasonably anticipate a reaction, which would then align with our higher time frame target for the trade, given that even a minor reaction to a higher time frame key level can potentially trigger a significant reversal in the lower time frames. It's essential to consider this dynamic. One more straightforward strategy to protect a portion of your profits is to reposition the stop loss of the second trade when the price reaches your 1-to-1 target. In this case, you can move the stop loss to the break-even point, securing your gains on the second trade. For instance, you might find yourself in a situation like this. Your first position has reached the 1-to-1 target, which means you've secured profits on it. Now, it's time to reposition the stop loss of the second trade to the break-even point. This precaution ensures that in the worst-case scenario, you'll retain the gains from the first winning trade. Now, this concludes our discussion of the first profit-taking technique, which is an excellent way to set our targets and manage open positions. But there's another noteworthy strategy that allows us to capture trades with incredible risk-to-reward ratios while minimizing trading stress. Are you ready to embark on an exciting journey into the world of online trading? Look no further than HankoTrade, your trusted partner for a seamless trading experience. Discover the power of HankoTrade and take advantage of our exclusive offer, a 100% deposit bonus when you sign up today. That's right, we're doubling your investment right from the start, giving you the edge you need in the financial markets. But that's not all. With HankoTrade, you'll have access to a user-friendly platform, cutting-edge trading tools, and a wide range of assets to choose from. Whether you're a seasoned trader or just starting, our platform caters to all levels of expertise. Don't miss out on this incredible opportunity to boost your trading potential. Click the link in the description to register now and claim your 100% deposit bonus. Join the HankoTrade community and start your journey towards financial success today. Number 2, tracking profits. In the tracking technique, we aim to maximize profits while minimizing trading stress. Here's how it works. Once we've entered the market and the price aligns with our predictions, we allow our profits to run while also repositioning our stop loss below the latest significant market structure. Let's illustrate this with an example. Consider a bullish market where the price has rejected the 50 EMA and formed an engulfing candlestick, which serves as our entry signal. This becomes our entry point, and we set our stop loss accordingly. In this technique, as the price continues to move in our favor, every time it breaks a significant structure to the upside, we reposition our stop loss just below the latest swing low. This approach serves two purposes. One, it secures the profits we've gained by adjusting the stop loss. If the price reverses and hits our stop, we would still have a winning trade. This helps alleviate the negative psychological aspects of trading since we know we've already secured a profit. 2. Additionally, this technique sometimes leads to substantial profits while still risking the same initial amount. It allows us to capture significant market moves while maintaining a risk-controlled approach. For example, in this scenario, we've witnessed a break of market structure. So it's time to reposition our stop loss below this swing low. By doing this, even if the price were to reverse, we can still capture a portion of our profits, ensuring that we don't incur any losses. However, if the price continues in the desired direction, we have potential to accumulate more significant profits without the fear of losing money. Let's continue and observe what unfolds. In this instance, the price has broken above the structure level, prompting us to reposition our stop loss just below the swing low. It's important to note that you should allow some breathing room for the price, avoiding attaching your stop loss too tightly to the bottom of the candles. This process continues until we reach a higher time frame resistance area. At this point, we have the option to close all of our positions. Alternatively, in the event of any sudden market reversals, the market may hit our stop loss, but we would still have gained profits. First major advantage of this tracking strategy is that typically, through the first repositioning, we will be at more than just the break-even point. This significantly reduces the stress associated with the outcome during trading. The second advantage is that sometimes this strategy results in an impressive risk-to-reward ratio, allowing for faster account growth. This technique offers traders a powerful way to manage trades and maximize their profit potential while keeping risks under control. Now let's move on to practical examples on the chart here. We have the pounds to dollars pair on a 1-hour chart. Upon inspection, we can observe that the price has recently broken below the 50 EMA and established a new low. This indicates a bearish bias, and we're inclined to trade in alignment with dominant downtrend. To enter a short position, all we require is a strong bearish engulfing candlestick pattern. However, before making this trade, it's prudent to check the higher time frame to gain a broader perspective of the market. Now let's shift our attention to the 4-hour chart. Here we can clearly identify a robust demand area marked by multiple price rejections. This area presents a high likelihood that the price will rebound once more. However, it's worth noting that there is still some distance before reaching this significant level. The higher time frame analysis serves to confirm that we can indeed take a short entry in alignment with our long-term target, which is set at this level. With this higher time frame perspective in mind, let's return to the 1-hour chart for our detailed analysis. In this time frame, all we need to enter a short position is an advanced bearish engulfing candlestick. This is part of our second trading model. The price rejected the 50 EMA as indicated by these candles. It formed an engulfing candlestick pattern, which serves as our entry signal for a short trade. Now we proceed to open 2 positions, with each position carrying half of our desired risk for this trade. The first position aims for a 1-to-1 risk-to-reward ratio, while the second targets the higher time frame key level. As we monitor the market's progress, we observe that the price has successfully reached our first target. This results in one winning trade with a 1-to-1 risk-to-reward ratio. However, the second position remains active. If you decide to secure these profits, one option is to adjust the stop-loss of the second trade to the break-even point. Nevertheless, we typically refrain from making this adjustment. This is because the market often experiences fluctuations before reaching higher time frame key levels. For added safety, we prefer to place the stop loss above this swing high. Even if the price were to reverse and hit our stop, we would still be at break-even thanks to the profit from the first trade. Now let's examine another example. In the 30-minute time frame, we have the Dow Jones Index. The market has broken above the 50 EMA and established a new high, signaling a bullish bias. The price has also exhibited a rejection of the 50 EMA-OI, accompanied by a bullish engulfing candlestick pattern, which serves as our entry signal. Therefore, let's initiate a long position and implement the tracking profits technique for this trading setup. However, before proceeding, it's essential to conduct higher time frame analysis and establish a long-term target for this trade. Now, if we shift our focus to the 4-hour chart, we can clearly observe that the market has recently experienced a rejection in this demand area. In terms of our long-term target, we're setting our sights on this supply area. It's noteworthy that this particular supply zone has served as a significant turning point on 2 previous occasions. Therefore, we have considerable room for price movement before reaching this target. Now, let's return to the 30-minute chart. To execute our trading plan, we will open a long position and place our stop loss just below the engulfing candle. We'll then begin tracking our profits. In this strategy, whenever the price advances and breaks through a structure level, we will reposition our stop loss just below the most recent swing low. As a visual representation, if we use this horizontal red line as our stop loss, it would look like this. This process continues until either the price retraces and hits our stop loss or reaches our higher time frame target. It's important to note that the tracking strategy has the potential to yield significant profits. However, it's crucial to backtest it thoroughly within the context of your trading plan to assess its performance. So that wraps up this video. I hope you found it valuable. If you did, please show your support by hitting the like button. And if you're new here, consider subscribing to our channel. We'll catch you in the next episode.